We've seen a huge rise in prices across the board in most things, new cars, especially as well. I believe they're cutting it by $10,000. And I'm just wondering if we're going to start to see this trend where, there was so much talk about high inflation, um, an acceleration inflation rate, that I'm wondering if it's going to reverse course now and we're going to see a deceleration and or um, a capitulation where there's just lowering and lowering of prices because people are getting hit hard in this economy. And when you look at things like the mortgage default rates, mortgage defaults jump at fastest rate since 2009. You remember what happened in 08, 09 was the junk bond crisis and the mortgage-backed securities going belly up. Well, that just had a ripple effect through the markets. Banks suffered, investors suffered. There was literally a collapse in the banking sector. Banks started getting gobbled up by bigger banks. So now we have these really big companies that are banks and brokerage firms combined. Happened up in Canada. There's only 6 main banks up here. So I think what's going to happen in the States, similar type of thing. But this is really tricky for a lot of reasons. There has been these interest rate increases. In fact, in Canada this month, in July, the rates were raised 25 basis points. So that's been the 10th raise. Now, here's the tricky thing about interest rate increases. The effects of them really aren't felt until about 12 to 18 months out. So if there was a monetary policy that was, okay, let's slowly ease into this. I could see 3 interest rate increases throughout the course of a year, but we've seen literally 10 increases. And we haven't at all felt the effects yet. So those are still to come. But early on, what we've seen is a huge spike. And if anyone who has an adjustable rate mortgage, you're going to see this increase as well. So if you have any consumer debt, any lines of credit, anything where there's an adjustable rate to it, you've seen your prices, your monthly payments go up dramatically. So let's go through this a little bit. Mortgage defaults have surged at their fastest rate since 2009, as rapidly rising interest rates push more people into financial difficulty. Bank of England data show that the share of lenders reporting an increase in missed mortgage payments is now the highest it's been since the global financial crisis. The proportion of banks reporting an increase missed payments between April and June outweighed the number reporting a fall in defaults by a margin of almost 31% there. So we're going to start to see this play out even more. That's April and June. The Fed has said that they will continue to raise interest rates. And this is just going to continue, right? So reports of defaults have more than doubled compared to that at the start of the year, according to the bank's regular credit conditions survey. Lenders warn they